Section 3.2, Topic 4 of Paper 7 looks at the pricing of zero coupon bonds or zero coupon debt securities. Now, the pricing of any type of debt is the present value of the future cash flows. And as we'll see in a moment, when we're dealing with coupon debt securities, we've got to discount the coupons and the principal repayment. Whereas with zero coupon bonds, we only have to discount the principal repayment. That is the face value of the bond. So here's an example in section 3.2, the bullet point before the diagram: zero coupon bond with a face value of 100 Hong Kong dollars with 3 years to maturity, providing an annual yield of 5%. We're being told it will be priced at 86.38. How is 86.38 arrived at? By discounting the 100 Hong Kong dollars we'll receive in 3 years' time back to present value using the yield of 5%. And we're taking it back 3 years, so the denominator there is raised to the power 3. So it's 100 divided by 1.05 raised to the power 3. We're discounting back 3 years, and the present value is 86.38. Now, the way they can examine this is to give you the information and then ask you to price the bond, or they give you the face value and the current price, and you've got to work out the annual yield, which needs a little bit of simple algebra. Section 3.3 moves on to looking at the pricing of coupon debt securities. And as I said, not only have you got the principal being repaid, but you've got the coupon payment each period. And in the example we're looking at, each year. So the third bullet point tells us a 3-year 10% coupon bond with a face value of 100 Hong Kong dollars provides a yield of 8%, and it will be priced at 105.17. Now, one very important point to pick up here is that the coupon, the 10%, is greater than the yield 8%. That means it will be priced at a premium. Coupon is attractive compared to the yield, so we'll pay more than the face value. And as you can see, it's priced at $105.17. If the coupon was less than the yield, it would be priced at less than the face value and be known as a discount, trading at discount. If you have a circumstance where the coupon is equal to the yield, then the bond will be trading at face value at par value. Be aware of those three relationships for the exam, because those can be a shortcut to the answer rather than having to plow through the calculation. Now, that calculation that I refer to is at the bottom of page 7. We show it in two ways: one in a table with the cash flow each year, and then one as an equation, a calculation. So if I go to the second form first, P equals first cash flow 10 discounted back 1 year at the yield of 8, so divide by 1.08. The second cash flow of 10 discounted back 2 years, so I divide by 1.08 squared. The third coupon 10 discounted back 3 years at 8%, we divide by 1.08 raised to the power 3. And the principal also comes back 3 years, so we divide by 1.08 raised to the power 3. So those four terms, the 9.26, 8.57, 7.94, and 79.4, are all in present value. We can add them together. There is the present value of the future cash flows, 105.17. And in table form, we introduce the discount factor, and the discount factor is just the denominator of each calculation in decimal form. As I say, in the exam, you could have a question where a shortcut is provided. You probably be able to answer it in 15 seconds, 30 seconds, and that is looking at the relationship between coupon and yield. If you don't see that and you go into the actual long-winded calculation, you may lose precious time in the exam. So I just offer that as advice. Section 3.4. On credit ratings, as it says, major risk of investing is the chance the issuer will not be able to pay the repayments, defaults, and that's referred to as default risk. Higher the default risk, higher the yield required by investors to invest. and the other way around, lower the default risk. With strong issuers, lower the interest they need to pay, lower the yield of the debt. Now, who helps us determine what the default risk is of issuers? It is the credit rating agencies, the likes of Moody's, Fitch, S&P, and they will provide credit ratings for specific debt issues. Moving on to section 4, the role of the yield curve. Yield versus price. We have to be aware of this relationship. The yield, the security, is its effective annual return, express a percentage of the current market price determined by a number of factors. So what is the yield determined by? The risk profile, the term, and the taxation position. So with the risk profile, the higher the risk of the security, the higher the risk premium, the higher the yield, therefore the lower the price. Term, the longer the term, the higher the expected yield because money is being tied up for a longer period of time. We refer to that as liquidity risk. Taxation, those with tax benefits will trade at a lower yield because they're popular, they're priced higher. And the bullet point underneath that material, remember, the higher the yield, lower the price, lower the yield, the higher the price for bonds. Very important relationship. Moving on to different types of yield curves. What is the yield curve? It is, as it says, a line plotting the yields of selected benchmark securities, same type, with different maturity from short to long term. So on these three yield curves that we can see, the left-hand side of the x-axis is short-term maturities. Moving up the x-axis, we get to longer-term maturities. These yield curves considered by country and by market used to forecast future direction of interest rates and inflation. Now, the benchmark securities selected are usually highly rated government-issued debt, such as US Treasury bonds. And then we have non-government securities, such as corporate debt. Those will always be higher risk than government securities. Government has virtually no risk of defaulting, well, the major developed countries. But companies, no, they do have higher risk. So their yields, the corporate bond yields, will be above those of government debt, reflecting that premium, compensating for the higher risk. Three types of yield curve. First one is the normal one. Positive or normal, also referred to as upward sloping. And here the yield increases with an increased term to maturity. The longer the term, greater the uncertainty, therefore the higher the required yield, all else being equal. Consistent with the expectation of rising inflation, be aware of that. An upward sloping yield curve, investors are expecting inflation to rise in the future. Now the next one is the downward sloping yield curve, or negative or inverse. It's opposite, as you can see, the positive yield curve, where longer term interest rates are expected to be lower than current or short term interest rates. Now this often reflects a hike in short term interest rates. So for example, a government puts up interest rates to try and combat inflation. But the short term interest rates being higher is a short term phenomenon, and the market will expect interest rates to come down. And then the flat yield curve, well, that can reflect expectation of stable interest rates or transition from a positive to negative yield curve or vice versa. Now these yield curves are moving all the time because bonds are being priced, yields are changing in real time. And so if you had a sort of took photographs of the yield curve over time, you would see the yield curve moving around. And if it's moving from positive to negative, it may go through the flat stage. Moving on to section 5, the Hong Kong debt market. And we've got various aspects of the material here. Development of the Hong Kong debt market. Given Hong Kong's consistent budget surplus, well, over the years, yes, more years than not, it's been a budget surplus. The Hong Kong government, unlike many other governments, have never had the need to raise capital by issuing debt. But government initiatives over the years has led to an active secondary debt market. Now, the Hong Kong Monetary Authority issues a number of debt securities on behalf of the government, and the important ones, the exchange fund bills, the exchange fund notes. Now remember, bills are short term, Notes are long term. Bills, maturity of less than 1 year. Notes, the maturity is greater than 1 year. And as we're told there, the futures exchange accepts these bills and notes as margin collateral for trading stock options and futures, and that increases the Hong Kong dollar fixed income market liquidity. We've got some notes on the implementation of the exchange fund bills and notes, the program. Also, we refer to the listing of exchange fund notes on the Stock Exchange of Hong Kong. We've given some notes there on the establishment of the Hong Kong Mortgage Corporation. That was established in 1997, and it's the equivalent of the US Fannie Mae, Freddie Mac. And its objective is to develop Hong Kong's secondary mortgage market involving purchasing of mortgages, often from banks, and then issuing mortgage-backed securities that are linked to the underlying mortgages. Renminbi debt market. Well, it says there, Hong Kong is fast becoming China's financial hub for renminbi. We'd like to think that's still the case. And those bonds are known as dim sum bonds. So they're issued in Hong Kong in renminbi. And we've given some details of the first issue and some of the continuing developments. The mutual debt market, that refers to the bond connect between Hong Kong and mainland China, established in 2017. Currently, we only have northbound trading. That is, Hong Kong investors can invest in mainland bonds. Security margin financing, that is where financiers lend money to investors to enable them to buy listed securities. So they put forward a margin themselves, the investors, and the lender, the financier, will lend the remainder. And the point that's been made here is the exchange fund bills and the exchange fund notes are used as collateral for trading in shares, stock options, listed on the stock exchange, and futures on the futures exchange, but also for securities margin financing collateral as well. Now, repurchase agreements, we need to be aware of this because questions can pop up and it's quite technical. So let me read through the material and then just reflect upon it. Repurchase agreement. We have one party selling securities to another in return for cash with an agreement to repurchase equivalent securities, so repurchase them back at an agreed price, a higher price on an agreed future date. This is often done for bank liquidity with the Hong Kong Monetary Authority. So a bank will sell securities to the Hong Kong Monetary Authority at the end of one day and then buy them back the following day at a higher price. It is providing the bank with liquidity, and that higher price reflects an interest element of the payment. Now, the repo buyer, which in my example are the banks, they are selling the securities, able to source funds to cover any liquidity shortfall. A repo, that's the shortened version, the repo can be thought of as a short-term secured loan with collateral. It's widely used by central banks and money markets to relieve money market shortages. That's the important point. And the last bullet point gives us the description of the Hong Kong banking liquidity relief. In Hong Kong, banks can obtain temporary liquidity from the Hong Kong Monetary Authority through the discount window, and that term is examined, discount window, by using repos with exchange fund bills and notes as collateral. So the banks will sell the bills and notes to the Hong Kong Monetary Authority, who will provide the funds and then will buy them back the following day. Okay, the Hong Kong Monetary Authority is selling a repo by doing that, and that's sometimes quite confusing. So the Hong Kong Monetary Authority is selling, the banks are buying, and they enter into these repurchase agreements. Tax exemptions and concessions. Some debt provide exemption from Hong Kong profits tax and stamp duty. The exchange fund bills and notes are effectively backed by foreign currency because of Hong Kong's foreign currency reserves in the exchange fund. There is a government bond program, and now we have these bonds issued with maturities of 2 to 10 years. Maximum balance of the initial program was $100 billion Hong Kong dollars. It's now gone up to 200 billion Hong Kong dollars. And there are other initiatives in play to encourage debt trading in the Hong Kong market. Section 5.2, the structure of the debt market, different structures, primary versus secondary, short-term debt versus long-term, government and non-government debt. Well, non-government is corporate debt. And then we've got structured finance security debt. Now, we've covered a number of these points elsewhere in paper 7. So the notes have been all brought together under the heading of primary and secondary debt markets, short-term and long-term debt markets. Remember, the distinguishing feature is 1 year. Less than 1 year maturity, short-term, more than 1 year, long-term. And then government and non-government debt securities are just highlighted there. Okay, moving on to the last couple of pages at paper 7. Structured finance and securitized debt. Securitization, that's where assets are taken, repackaged, and securities are issued with the assets as backing. And generally, there are two basic markets: mortgage-backed securities and asset-backed securities. Those asset-backed securities could be student loans, the underlying assets, credit card receivables, etc. Collateralized debt obligations, CDOs, is where we mix up a number of asset-backed securities, repackage them, and issue different security tranches. An asset-backed commercial paper, wide variety of debt, backs issuance of commercial paper. Now, a lot of these products was what got us into trouble in 2008, and they tend to be heavily regulated nowadays. We then list different types of short-term debt versus long-term debt securities. Be aware of the differences, easy to examine, often a question along the lines of which one of the following is a short-term debt security or is not a short-term debt security, and the same with long-term. So read through the different categories and be willing to answer on the distinction between the two lists. Section 5.4, participants in the debt market, issuers of debt, investors in debt, brokers and traders, the regulators and the credit rating agencies. A lot of these we have touched on elsewhere in the paper 7 material. And finally, section 5.5 looks at trading and settlement systems. We're told that the debt trading in Hong Kong principally carried out OTC, over the counter, by telephone during business hours. Now, the Central Money Markets Unit, what's this? It was established by the Hong Kong Monetary Authority in 1990 to provide clearing, settlement and custodian services for traded debt. Please be aware of that. So the Central Money Markets Unit is the clearing, settlement, custodian for debt. And an interface was set up in 96 between the CMU and the RTGSA to perform real-time or end-of-day delivery versus payment settlement. It's getting a little bit technical. I'd certainly know that second bullet point. Okay, that brings us to the end of topic for the debt market, and it tends to be one of the more examined topics. That is to say, it has the highest number of questions in paper 7. So I'd read through this material, I'd be familiar with it, but as ever, best way to build up your short-term memory is to do the practice questions. And as I've said before, we have over 300 paper 7 practice questions on the Examinator.online platform.